The global airline industry crossed $1 trillion in annual revenue for the first time in history. And after all of it, after paying for fuel, labor, aircraft, gates, and crews, the average airline earns $7.90 in net profit per passenger, less than the price of a Big Mac. Warren Buffett called airlines a death trap for investors. The economics of owning one explain why. Every airline flight is powered by a complex web of costs, most of which are locked in long before the first passenger boards. In 2026, the global airline industry will spend $981 billion just to keep planes in the sky. The largest share, $729 billion, comes from non-fuel operating expenses. Labor alone makes up 28% of that total, surpassing even fuel as the single biggest cost line for the first time. That translates to about $272 billion spent on pilots, cabin crew, ground staff, and management. Aircraft leasing adds another $98 billion, while maintenance and engineering require $88 billion. Airports and air traffic control fees account for $61 billion. And a further $52 billion goes to engine reliability and other technical needs. Fuel, though no longer the top expense, is still enormous and volatile. Airlines worldwide will pay $252 billion for jet fuel in 2026, nearly 26% of their total costs. A sudden spike in oil prices or a supply shock can erase profit projections overnight. Then there are the planes themselves. A single Boeing 737 MAX lists for around $120 million, while a new Boeing 707-9 can reach $445 million before discounts. Most airlines do not buy aircraft outright. They lease them, spreading the cost but locking in high fixed payments for years. This capital intensity means that even when planes are parked or routes are cut, huge costs remain on the books. The result is a business where most expenses are fixed and scale is essential. Filling seats is not just about growth, it is about survival. Each empty seat is a lost chance to spread these heavy costs. In this environment, efficiency is not a strategy, it is a matter of staying afloat. On paper, the math of airline profits looks almost trivial. Each seat on every flight represents a unit of revenue and cost, measured by two numbers: RASM, revenue per available seat mile, and CASM, cost per available seat mile. In 2026, IATA projects the global average RASM at 60 cents, while CASM sits at 42 cents. The spread between them, just 18 cents, must cover every financing cost, every tax, and still leave something for shareholders. But this spread is not guaranteed. It depends on how many seats are actually filled. The industry's break-even load factor, the percentage of seats that must be sold just to avoid losing money, hovers around 80%. In 2026, the world's airlines are forecast to reach a record load factor of 83.8%, meaning that just 3.8% of seats above break even separate profit from loss. If a flight falls short, the economics can unravel quickly. Consider a single 200-seat jet flying a medium-haul route. If only 150 seats are sold, fixed costs like crew, fuel contracts, and aircraft leases do not shrink. Every empty seat is lost revenue, but the costs remain. Filling those last few seats can mean the difference between a profitable flight and a loss. This is why airlines chase load factors with such intensity, offering last-minute discounts and complex fare structures to avoid flying empty seats. The reality is that even with $1 trillion in annual revenue, the industry's average net profit per passenger is just $7.90, a figure often compared to the price of a Big Mac. The margins are so thin that a minor dip in demand or a small cost shock can erase months of gains. Airlines live and die by the unit spread, and the relentless pressure to keep every seat filled defines the fragility at the heart of the business. For all its scale and complexity, the global airline industry faces a stubborn arithmetic problem. It struggles to create real value for its owners. In 2025, airlines posted a return on invested capital, ROIC, of just 6.7%. That figure sounds respectable until it is compared to the weighted average cost of capital, or WACC, which investors expect to be at least 8 to 10% for a business this risky and capital intensive. The gap is more than academic. It means that, as a group, airlines are not earning enough to justify the billions poured into aircraft, infrastructure, and technology. IATA's value creation study shows the impact in stark terms. Only 41% of carriers worldwide generated positive economic value in 2024, even during a year of record revenue. The rest, nearly 3 out of 5, actually destroyed value for shareholders. This disconnect has become a defining feature of the business. Willie Walsh, Director General of IATA, has been blunt. The airline industry collectively does not earn its cost of capital. The industry's net margin has never surpassed 5%, and even in banner years, profit per passenger hovers at the level of a fast food meal. Legendary investor Warren Buffett once called airlines a death trap for capital. His own experience, buying billions in airline stocks only to exit at a loss during the pandemic, underscores the hazards. The core problem is not just low profits, but a structural inability to turn revenue into lasting value. For airlines, every dollar earned is shadowed by the cost of keeping planes flying and fleets renewed, making the search for alternative profit levers a matter of survival, not just strategy. Profit in the airline business is not evenly distributed. A glance at the regional margin leaderboard reveals a striking divide. The Middle East stands out with a net margin near 8.7%, far above the global average. Carriers in this region benefit from state-backed financing, government fuel contracts, and a powerful hub-and-spoke model that funnels high-yield long-haul traffic through sprawling airports. Emirates and Qatar Airways, for example, are able to combine premium demand with cost advantages that few rivals can match. In contrast, Africa's carriers scrape by with margins around 1.3%. The obstacles are steep, limited network scale, currency swings, high airport and air traffic control fees, and older, less efficient fleets. Even a minor cost shock can push many operators into the red. Europe's low-cost carriers, like Ryanair and Wizz Air, have carved out a middle ground with margins between 4 and 5%, sometimes higher. Their formula relies on high load factors, relentless cost discipline, and a growing share of ancillary revenue. Latin America, meanwhile, struggles to keep pace, with margins below 2%. Economic volatility, high fuel taxes, and infrastructure bottlenecks weigh heavily on results. North America claims the largest absolute profit pool, thanks to a mature market, strong business travel, and extensive use of loyalty programs and ancillary sales. Yet, even here, returns are modest by the standards of other industries. The map of airline profitability is a patchwork, shaped as much by geography and government policy as by business strategy. These regional differences highlight why airlines look beyond ticket sales, searching for new ways to boost margins in a business where the odds are rarely in their favor. Ancillary revenue has quietly become the lifeline for many airlines, especially at the low-cost end of the market. Today, fees for checked bags, seat selection, priority boarding, and onboard sales account for as much as 45 to 50% of total income at ultra-low-cost carriers like Spirit, Ryanair, and Frontier. The IdeaWorks yearbook tracks this surge, showing how the global share of ancillary revenue jumped from just 5% in 2010 to about 15% by 2024. These unbundled charges allow airlines to advertise rock-bottom base fares while turning a profit on everything else. It is a model built for razor-thin margins. Every extra dollar from bag fees or credit card partnerships drops straight to the bottom line. Loyalty programs have become even more valuable. The American Airlines AAdvantage program alone is valued by analysts at $20 to $30 billion, sometimes more than the airline's own market cap. In 2020, American used AAdvantage as collateral for a $5.5 billion loan, underlining its role as a financial engine. For many carriers, selling frequent flyer miles to banks and partners now delivers higher margins than ticket sales. In a business where every cent counts, ancillaries and loyalty are no longer side hustles, they are essential to survival. The list of pressures on airline economics keeps growing. In 2025 and 2026, supply chain disruptions alone will add more than $11 billion to industry costs, as airlines face unprecedented waits for aircraft, engines, and critical parts. The average fleet age has climbed from 9.7 years in 2018 to 11.3 years in 2024, forcing carriers to operate older, less efficient planes that burn more fuel and require extra maintenance. Leasing rates have risen as airlines extend contracts to cover delivery delays, tying up capital and squeezing margins even further. Labor is another flashpoint. Pilot shortages have led to grounded flights in Africa and Latin America, while union negotiations in the US have pushed pilot wages up by 6 to 8% in just 2 years. Training pipelines cannot keep pace with retirements, and the cost of attracting new talent is rising everywhere. Regulation adds another layer. The European Union's sustainable aviation fuel mandate will increase costs by up to 1% of CASM for affected carriers, a burden that will only grow as targets tighten. And when conflict flared in Iran in 2025, global jet fuel prices jumped 6% overnight, with insurance surcharges adding $500 million to operating bills for airlines serving the region. Each new shock widens the gap between revenue and the true cost of capital, making the industry's fragile economics even harder to repair. Today, airlines move billions, but earn less per passenger than a fast food meal. Net margins are still under 4%, far below their cost of capital. As Willie Walsh notes, the capital gap persists, and as Warren Buffett warned, the industry's scale can't outfly its economic gravity. The contradiction remains unsolved.